Welcome back, everyone. It's finally time again that we take a look at our investments. We take a look and see how things are going. I like to check in on my investments from time to time, see how my companies are doing, see how the portfolio is performing. And here we have two separate portfolios. The first one is the passive income account. This is my main one. It's the largest account. I've been tracking it the longest, and I show this one every single week publicly. But then I have another portfolio called the Story Fund. If I switch over to the Story Fund, this is what it looks like. It's a bit smaller because I started it more recently, but this portfolio is highly concentrated into only 5 companies. It's performing exceptionally well, and I have the express goal of beating the S&P 500 with this portfolio. So everything I'm doing with it is a nice, healthy, friendly competition between these holdings and the S&P 500. Now let's go ahead and jump in, and the first thing I want to go to is the performance. Let's take a look at how this is doing. I have here a chart that compares the S&P 500 against the Story Fund as if I deposited money equally at the same time into both of them. So this is a very fair way to treat the performance benchmark. I'm acting as though I bought each of these at the same time. And if we look at this, the performance was very similar for the first year. And then my portfolio suffered from 2022 to 2023. It suffered because a lot of my key holdings like Netflix and Amazon in particular had huge sell-offs. But then we had a rapid recovery. I bought a lot more Netflix. I bought a little bit more Amazon during the lows, and that helped boost the recovery. So you can see this massive relative recovery with my portfolio in SPY over the past year. And that momentum has continued. In early 2024, the Story Fund started to take the lead over the S&P 500, and that difference in lead is becoming greater and greater. Now the S&P 500 has a return of 34%, the Story Fund has a return of 44%. So as of today, I'm in the lead of the S&P 500 by only 11%. It's a nice little margin, but what I don't want to do is start to become conservative and back off and play things safer because I'm in the lead. What I plan on doing is continuing to expand that lead, to distance myself from the S&P 500 more and more. And I plan on doing that, again, with a concentrated portfolio. I really believe that to get a large lead over the S&P 500, you have to make some concentrated bets into great companies that have very predictable outcomes in outperforming the market. That's much easier said than done, but these are the bets that I'm making. So if these bets don't work out, I won't beat the S&P 500, but if these companies do, I should beat it by a wide margin. And of course, I believe that these investments into these companies are very predictable winners. And I've ranked these companies by predictability, with Amazon and Netflix being at the very top. Amazon is 33% of this portfolio. So a third of the portfolio in Amazon. It's way overweighted over the S&P 500 and the QQQ. So if Amazon does really well, this portfolio will do better than the QQQ and the S&P 500. And that's why I've ranked it so highly. Let's go ahead and take a look at Amazon and why I have so much money and conviction in this stock. Amazon is a company that I don't believe just represents one company. Like, it's one ticker symbol, but look at the industries that Amazon's in. They are first place in cloud. AWS still has the commanding lead in cloud. Now we have some data on Azure, it's second place, it's growing faster, but still every quarter, Amazon is adding more dollars to their service than any other service. They're growing at a slightly slower rate, but they're already much bigger. And I believe they're going to continue to keep the lead over Microsoft Azure. Cloud in Amazon is a way that I'm playing the AI game without directly playing the AI game. Meaning that there's more direct investments. If you invest in something like Nvidia or Tesla, you can invest in Nvidia continuing to make chips. You can invest in Tesla figuring out full self-driving. But I believe that each of those is a little bit less predictable than the cloud. The cloud still benefits dramatically from artificial intelligence. They're hosting the powerhouse behind running all of these large language models. And they do this in a manner that's highly predictable, that has customer lock-in, that's very long secular trends of growth. So I believe that Amazon's cloud represents a way to capture a huge part of the upside of AI without getting the cyclicality of Nvidia or the innovation struggles of Tesla. I believe that you're getting a lot of the benefit without as much of the risk. And that's why I've made the calculated bet on investing in Amazon over Tesla and Nvidia. Now, there's a chance Nvidia just continues to rocket up or Tesla figures out full self-driving. In either case, that's great for those companies, but it still doesn't hurt Amazon. Amazon should do fine either way. Now, Amazon's not just first place in cloud, they're also first place in online retail, which at first thought you may say, online retail? Like, retail's not a great business, but remember that Amazon wraps this into services. They use online retail to sell Amazon Prime, which is a high margin yearly subscription. They also have their seller services, which means that the sellers provide all the product, they just charge services. So Amazon's first place in online retail is a very meaningful market share. They have around 40%, and that's a really good business to be in. It also makes it so Amazon can be third place in advertising. They have the best advertising business behind Google and Meta. And I actually believe that there's many advantages to Amazon's advertising business. So they are first place in cloud, first place in online retail, third place in advertising, and they're second place in video streaming, which again, a lot of people don't see as a big deal. But when you look at the streaming world, it can be highly profitable. Take a look at Netflix. They're highly profitable, and Amazon is following in their footsteps. And Amazon has an advantage where they've implemented advertising into everybody's account. So being second place in streaming is another important market to be in. So overall, when I look at investing in a company, I look to see if they have a dominant market share in an important industry. And Amazon doesn't just have one, they have four. They have 4 dominant market shares in 4 different important industries. So I see it as a very attractive situation with all the industries they compete in. Now, we also have operating leverage. Operating leverage and scale should cause a large influx in free cash flow. Operating leverage means that they can cut down on costs or keep their costs fixed while growing revenue. And I believe that's what Amazon is doing. They say that they're investing in AWS, but that investment is a very predictable, high return investment. So they're only investing money in things that they know they'll make a lot more money. And while their costs on CapEx, on infrastructure slow down, the operating leverage will kick in, which means that Amazon should be generating upwards of $70+ billion. If they do this, that is a huge step up from their previous year. So we could see a story where Amazon's generating more and more free cash flow, more and more free cash flow per share at an accelerated pace. Usually stocks go up when free cash flow per share goes up dramatically. And then finally, the valuation of Amazon is not too demanding on a forward-looking basis. When I run my analysis and my DCF, I see Amazon trading at a 3.5% free cash flow yield. That doesn't seem too expensive to me. Now, next up in the portfolio is Netflix, which is a 30% position. This is another massive holding that's done really well over the past year as Netflix has had a big recovery, but I still believe there's a lot more to come with Netflix. Let me go ahead and explain what I believe are the catalysts for Netflix. First of all, Netflix is already an established, large, profitable, and growing streaming business, which no other streaming business is. Netflix is completely unique with their scale. They're completely unique with their profitability and with their 270 million subscribers. This is extremely difficult to replicate. So part of a moat of a company is how difficult would it be to replicate the company? That's really part of a moat. How could you rebuild the thing that they've built? And in order to do that with Netflix, it would take an immense amount of capital and subscribers and continued cash flow, more so than any company's willing to do. So right now, I believe that Netflix has an unassailable position in streaming. I believe that their large scale, high profits, and the fact that they can continue to run the same recipe of reinvesting their large profits back into content keeps them well above competitors. We also look at the fact that they are in an industry of entertainment, which is a large and continuously growing total addressable market. That's a very advantaged industry to be in. Most companies have issues where they run into natural growth paths. There's not enough people to have the products they want, but Netflix offers entertainment. Entertainment is something that's universally loved by everyone. When you're doing analysis on Netflix, you're not saying how many people can they have in the US or Europe or even South America. You're saying everywhere in the world except for maybe Russia and China. Everywhere else wants entertainment. And more people every single day are getting fast-speed internet. As economies grow, one of the first things they want to do is put in high-speed internet. So the total addressable market of Netflix is already pretty big, but it's also growing every day. Now, we also look at the fact that when I just look at basic products, again, people love scripted, long-form, episodic entertainment. And this is unlikely to change. This is also different than YouTube or social media or TikTok. People try to basket these together like YouTube's a direct competitor to Netflix. And I get that there's many people, especially ones on YouTube, that prefer YouTube. I understand that. But they are not the same. YouTube's not really a direct competitor to Ozark or Stranger Things. It's not long-form episodic entertainment. It's a different style of entertainment, and I believe people will like both. So I think many people are going to both have a Netflix account while enjoying YouTube. I believe they can both survive and even thrive together. Now, another thing that I do analysis on with Netflix that I think Wall Street is way off on is their estimated content costs at scale. Wall Street believes that Netflix will continue to have to increase content costs every single year as they scale. But Netflix has proven that they can continue to optimize their content, they can make it more efficient, they can have a higher percentage of hits with the same budget. So they can spend the same $15 to $17 billion per year while growing 10 plus million subscribers per year. And if they're doing that, they have huge operating leverage. And I think this is the biggest opportunity for Wall Street to be wrong. Another thing that I've noticed that Netflix is doing is that they have huge opportunities for AI to enhance the engagement and interface of Netflix. What they're working on right now is making it so that every time you log into Netflix, it already knows your viewing history, what type of content you like to view at certain times of day, and it's going to present the best options uniquely to you based on your viewing history. And then the last thing I'll mention, which isn't listed here, is that Netflix is in a situation where they can continually do buybacks. So if the stock takes a big dip, they can continue to scoop up shares, reduce their shares outstanding, and grow their earnings per share at an accelerated pace. So these are the major reasons that I think Netflix will continue to be a good investment. Next up, we have Google, which is an 18% position. So I'm heavily overweighted in Google as well. These are still very large positions. Let's go ahead and talk about Google for a minute. There's a couple main points I'd highlight with Google. First of all, I think the cloud growth of Google is underrated. It's something the company's focusing on with a huge amount of effort, with a huge amount of employees, and they're doing a good job. They're actually growing their cloud at a very steady rate while increasing margins. We can see this if we bring it up on Qualtrim here. I can type in Google and I can take a look at their cloud margins and their cloud growth. If we break this up by segment, we can look at Google Cloud here. We'll cross out all the others. And this is the only segment of business that's continually growing every single quarter, quarter over quarter. You can see that this is just astounding growth on a quarterly basis. And it's very predictable. This will continue to happen for likely years. So I like seeing the growth of overall revenue of cloud, but if we combine that with the cloud operating margins, it paints a very positive picture. Not only is the revenue growing, but the cloud margins are going from the negative into the positive. They're not quite as steady, but over time this is going to continue. Google Cloud will get their operating margins higher and higher and higher, which will of course have a huge impact on its profitability. So to me, Google Cloud represents this really long tailwind of revenue growth mixed with margin expansion. I like seeing that in important segments. Then we have the search market. There's a lot of chatter about how it's under attack, it's unpredictable. There was people like Brad Gerstner and popular figures saying that the search market is certainly going to be taken away by the large language models. I disagree with that take. We've seen no evidence, no real data to support the idea that ChatGPT is taking over Google search. And we haven't seen any evidence that Google Bing is taking meaningful market share from Google search. In fact, Google search maintains its total market share and Google search revenue continues to grow. Now, we also have the fact that Google, unlike OpenAI, has numerous assets to apply its AI advancements into. They already have Gmail. They have Maps, they have YouTube, they have Google Drive and Google Docs, they have search, and a lot more. And they're using all of these assets that they already own, and they're applying all these AI advancements into these assets. Now, OpenAI is doing a great job, but they don't have these existing assets to leverage. Then we have YouTube, which I believe will continue to grow over time because it has no real competitors. YouTube is basically a monopoly of uploading videos yourself. And then finally, the valuation, simply put, for Google is not that demanding. The stock price has gone up, but the earnings continue to grow, and I believe there's more upside in the stock. Next up, we have Microsoft, making up 10% of the portfolio. AWS, Azure, and Google Cloud are like the landlords of the AI battle. It doesn't really matter which individual AI company ends up winning. No matter who wins, they're going to use these services. So at the end of the day, I believe that all three of these are inevitable winners, and I want all of them in my portfolio. Azure will end up being the second largest cloud winner next to AWS. That's a very desirable position to be in. Being second place in this category, I think, is very good. Microsoft already has a strong advantage in AI. They're putting AI tools like Copilot into everything that they're doing. They're even creating laptops that work specifically with AI, and they're likely to continue working with OpenAI and Sam Altman because they own roughly half or even more than half of the company. We also have the fact that Office 365 basically has a monopoly on office productivity software. That hasn't changed. It's just so commonplace. It's so ingrained in American culture to use Office 365 that I don't see that changing anytime soon. I don't see it changing in the next decade. So that's another staple of Microsoft that continues to latch onto different companies. I also expect that the merger, Activision Blizzard, mobile gaming, I think there's upside there, even though that's not the most important part of the company. Nearly all of the revenue is recurring, subscription, contractual, geographically diversified, and product diversified. They are diversified in the best ways possible, with a revenue that is the most resilient possible. That's why Microsoft has a better credit rating than the US government. This company is virtually indestructible at this point, and it has a better overall revenue profile than any other company I've seen. And finally, they also have a very clear return of capital policy. Like many of the companies that I like, they're doing buybacks, they're paying dividends, they're returning cash directly back to the shareholder, which means you have a very predictable way of getting gains. Now finally, the smallest holding here is S&P Global, which represents around 8.5% of the portfolio. S&P Global is a company that's similar in a way to Amazon, where they have a large concentrated position into many good industries. For example, they control roughly 45% of the credit rating industry. They share that with Moody's. So it's this huge duopoly that's really high margin, that's nearly impossible to replicate, that they have this advantage position to be a part of. Now, they also have a huge market share of the analytics and data for the stock market, for companies, for both private and publicly traded companies. They control and have proprietary data for a lot of that. They have something that's similar to Bloomberg Terminal called Capital IQ. Capital IQ is their product that they give to universities. They give to different investors that will pay a lot of money for it, different hedge funds, different institutions, to get very high level data, very detailed data on companies. Again, it's very similar to Bloomberg Terminal. So they're in that data business, they're in the credit rating business, they're in the indice business where they control the Dow Jones, and that's another very high margin, wide moat business. So I believe there's this huge trend that's moving towards the importance of data, and I think that S&P Global will continue to find ways to monetize their data. They also did a large acquisition. During this acquisition, they were able to buy the company with incredibly low interest rate debt. They used a lot of debt, but it's at like 3%. So they got very cheap debt to buy a company at a reasonable price. There's synergies with this purchase. Now, most of the cost saving synergies have been applied. They've already fired and cut off the different segments of the business they can, but they still say that there's ongoing revenue synergy. There's still room for improvement. Now, another thing that I point out that's unique to S&P Global and Moody's is there is a large slowdown in credit issuance amongst companies in 2021 and 2022. So there's a huge slowdown and a major revenue stream for S&P Global and Moody's that makes these companies appear more expensive than they actually are. Come 2025 and 2027, there's going to be a huge credit renewal wall. These companies will need to renew their debt. When that wall hits, S&P Global and Moody's will be re-rating this debt. They'll be required to if they want to get lower interest. So when we look at this, we can already see this start to happen. If we look at just the ratings business, we can see that just last quarter, it had a massive bump up from $830 million to $1.06 billion. And that's very high margin revenue. And we can expect to see that trend to continue of more and more debt issued and more re-rated. And then finally, one of the things these companies are best at is simply returning cash back to the investors in a very efficient manner. They do not waste money. They don't spend it on extravagant parties. They don't do meaningless acquisitions. They don't do pet projects by the CEO and executives. They simply earn a lot of money and return it directly back to the shareholders. So overall, I see this as another situation where this company represents relatively low downside and pretty good upside. So there you have it. There's my simple catalyst for each of my companies. Let me know if you agree with them or disagree, and it's okay if you disagree. Leave a comment. Let me know if I'm going to end up beating the S&P 500. And if you have any other suggestions or companies to look at, let me know as well. That's all for this time. See you in the next one.